Advanced audit and assurance. So we have covered audit planning, audit risk, analytical procedure. So let's move towards a good question on audit planning. We're having this question, Papaya. There are different requirements of the question. Part A for 6 plus 4, 10 marks. And then there is part B. And then there is part C and part D of the question. Altogether 36 marks question. So let's see what is part A. ISA 520 analytical procedures requires that the auditor performs analytical procedures during the initial risk assessment stage of the audit. In a planning stage, we need to perform analytical procedure to highlight risky areas. And these procedures, also known as preliminary analytical review, are usually performed before the year end as part of the planning of the final audit. Okay. Required, explain using examples the reason for performing analytical procedure. The reason for performing analytical procedures as part of risk assessment. Mean why we performed risk assessment. Risk assessment is a planning stage where we highlight risky areas. So why we perform analytical procedure at planning stage? We need to explain using examples. So we perform analytical procedure to identify or to highlight risky areas at the planning stage, like while comparing current year sale with the previous year. If it is increased by more than 10%, so that is what unexpected fluctuations. And if there is no justification for this change, this means this sale is what high risky area. So first reason we can say to highlight risky areas we perform. We perform analytical procedure at the planning stage, mean compare current year with financial statements with previous year financial statements to obtain knowledge about the client business and operations as well. Like we have compared assets with the previous year, and if there is increase in asset, this means company have acquired new assets. This means if company have acquired new asset, there is expansion of business. But if suppose assets has been decreased as compared to previous year, this means company have disposed some of the assets. And why company dispose assets? To resolve any of the cash flow issue. This means company might be facing cash flow going on issues. That's why for survival, company is disposing its assets. So we can get of knowledge about client business and operations while performing analytical procedures. So for knowledge purpose, we perform this. And there are 6 marks for 1 and 2 both. So two reasons we can discuss. Discuss the limitations of performing analytical procedure at the planning stage of the final audit that we have discussed straightforward. The data is draft. And if there is a major difference between draft and actual data, so planning could be disturbed. The draft data we obtain from company management, if there is deliberate manipulation in the data, so it could affect our planning. And sometimes client system is not designed in such a way like we can obtain information or accounting data like financial statements during the year. So it is difficult for performing planning through analytical procedure at the planning stage. So 6 marks we can obtain. Part B for 4 marks, explain and differentiate between the term overall audit strategy and audit plan that we have discussed already. Audit strategy to highlight risky areas and direct the work of audit team. Audit plan is a detailed procedure plan about how to conduct the audit. Audit strategy can be defined before plan. Plan is prepared after the strategy. Audit plan is more detailed as compared to strategy, as a strategy include only high risk areas, while plan include high risk areas as well as response to risk. Audit strategy defines scope, timing, and direction of audit, while audit plan defines nature, timing, and extent of audit procedure. This is straightforward. Let's move towards part D of the question. The reason we are covering this question, part D, for 16 good marks. Assess the risk of material misstatement. to be addressed when planning the final audit for the year ending 31st December 2009. We need to assess risk of material misstatement. Producing your answer in the form of briefing notes to be used at the planning audit meeting. So we need to prepare briefing notes, and there is a format to prepare briefing notes to, from, subject, date, and then we will answer the question. So risk of material misstatement, we need to identify. Risk of material misstatement mean inherent plus control. If examiner asks about audit risk, then we will discuss inherent control detection, and control risk we will end. Misstatements may not be prevented, detected, corrected by the system. But if we are finding control risk under risk of material misstatement, then we will link each control risk with the misstatement as well. In risk of material misstatement, every risk we need to link with the misstatement in the financial statements. For every risk, we need to explain the impact on the financial statement, either inherent, either control. Because risk of material misstatement mean risk relating to chance of misstatement in the financial statement. There are 60 marks. This means we need to identify 8 risks. 8 multiplied by 2 marks each will be able to get 60 marks. For 2 marks, we need to discuss one risk. And if we are discussing one risk for 2 marks, in that 1 mark is relating to discussing accounting standard relating to that issue. And other 1 mark is relating to explaining misstatement, what could be the effect on financial statement. This is the question where we need to apply accounting standard knowledge. How? Let's move towards question. So for 60 marks, risk of material misstatement we need to identify. Okay. So we'll put the heading risk of material misstatement. And whatever the issues we are finding, we'll put its heading and discuss. That's it. So you are a manager responsible for the audit of Papaya company, a listed company, which operates a chain of supermarkets with the year ending 31st December 2009. There are 3 business segments operated by the company. 2 segments are supermarkets chain, which operate under internally generated brand name. And the 3rd segment is a new financial services division. So there are 2 issues in this paragraph. First, company is operating under internally generated brand name. So put a heading, what brand? Is there any standard on brand name? IAS 38. Only purchase brand should be capitalized rather than internally generated. Is that? And if company have capitalized internally generated brand without meeting the criteria, chances that asset could be overstated. Are you with me? First we need to discuss the accounting standard. Per IAS 38, only purchased brand should be capitalized rather than internally generated. And if company have capitalized internally generated brand without meeting the criteria, chances that assets could be overstated. So this one risk we have discussed for 2 marks. Now company is operating in different segments. There are segments relating to supermarkets. And one new segment company have opened relating to financial services division. So we'll put the heading segments. And there is a standards on segmental reporting, that is IFRS 8. According to IFRS 8, segmental reporting. Segment could be of 2 types. One is performing different operations. from rest of the business. Like mainly company business is supermarkets, but this financial services division like a bank, they have opened any segment. So this is what segment that is performing different operations. And the other type of segment could be operating in different geographical area. And if your any of the branch is operating in different geographical area mean that area law regulation are different from rest of the business. So we'll call it segment. So segment are of two types. Business segments are of two types. Mean those branches, those business areas that are performing significantly different operations from rest of the business called segment, separate segment. Or if any of your business operation mean branch is operating in different geographical area, having a different law regulation, different risk and reward as compared to other areas of the business. So we call it segment. And if that segment is significant, and in accounting significant mean, if the revenue of that segment is 10% or more of profit, 10% or more of revenue, or 10% or more of total assets. It's not materiality. Materiality 5% or more of profit, 1% or more of revenue, 1% or more of total assets. In accounting, significant mean that segment contributing 10% or more of profit, total profit of the business, 10% or more of revenue, or 10% or more of total assets. If any one of the criteria is fulfilled, we will call it significant. And if any segment meeting the criteria of segment mean either this or this, and it is significant, there must be separate disclosures about that segment. Mean we need to disclose what revenue they are contributing, what are the costs relating to that segment, what is the profit relating to that segment, what are the assets associated with that segment, that we need to provide, that we need to disclose separately. And here, Papaya companies operating into different segments. So per IFRS 8, the financial services division, if it is meeting a segmental reporting criteria and it is a significant, so there must be separate disclosure in the financial statements about this financial services division. And in case of no disclosure, financial statement could be misstated. So we'll discuss like this. And we have discussed one new accounting standard IFRS 8. And this is the knowledge relating to IFRS 8 we require for this paper. Only this knowledge, not more than this. Are you with me? So two issues, two risks we have discussed. And these accounting standard reference we should provide in that paper. So the first business segment comprises stores branded as Papaya Mart. This segment makes up 3/4 of the supermarkets of the company and are large out-of-town stores located on retail parks on the edge of town and cities. These stores sell a wide variety of items, including food and drink, clothing, household goods, and electrical appliances. In September 2009, the first overseas Papaya Mart opened in Farland. Company has opened overseas branch as well. This expansion was a huge drain on cash resource, and company have invested huge amount over there, as it involved significant capital expenditure as well as an extensive advertising campaign to introduce the Papaya Mart brand in Farland. From here, we can discuss risk like if the investment relating to overseas brand, company have capitalized advertising campaign expense as well. So asset profit could be overstated, expenses understated. And the company have invested huge amount over there. If the operation does not work successfully over there, it could create a cash flow issue for the company, which may not be disclosed properly in the financial statements for IAS 1, but I'm leaving it for now. We will see if we are unable to identify 8 good risks, then we will move towards this. So I'm holding it now. The second business segment comprises the rest of the supermarkets, which are much smaller stores located in city centers and branded as Papaya Express. The express stores offer a reduced range of products, focusing on food and drink, especially ready meals and other convenience items. Okay, this is information. The company also established a financial services division on 1st January 2009, which offer loan, insurance services, and credit card to customers. That's why we have discussed this as a separate segment. The following information was provided during a recent meeting held with the finance director of Papaya Company. All the matters outlined in the notes below are potentially material to the financial statements. Okay. Notes from meeting held with 29th November. On 31st August 2009, Papaya Company received notice from a government body. What was the year end? 31st December 2009. So company received notice during the year that it is under investigation along with the 3 other companies operating supermarket chains for alleged collusion and price fixing activities. Company is receiving a notice from legal body like they were involved in some kind of illegal activities. If it is found guilty, significant financial penalties will be imposed on Papaya companies. This means there could be chances of provision or contingent liability. The company is vigorously defending its case. And company is defending the case. Vigorously means there could be chances company will pay the damages. So now we will put the heading what penalty or investigation. Either penalty or investigation. For IAS 37, if this notification from government is meeting the 3 conditions of provision like present legal constructive obligation from past event, probability of future economic outflow, and cost can be measured reliably, then there must be provision liability in the financial statements. In case no provision, liabilities expenses could be understated, because what is the accounting entry for provision? Expense debit, provision liability credit. So in case of no provision, liabilities expenses could be understated and profit overstated. Even if it is not meeting criteria of provision, there must be contingent liability disclosure in the financial statement. And in case of no disclosure, financial statement could be misstated. So we'll discuss both. So for IAS 37, the what company is facing claim or what notice. For IAS 37, if this notice from government body is meeting 3 conditions of provision, i.e. obligation, probability of outflow, as well as amounts can be measured reliably, then there must be provision in the financial statements. And in case of no provision, expenses, liabilities could be understated and profit overstated. Even if not meeting condition of provision, there must be contingent liability disclosure. And in case of no disclosure, financial statement could be misstated. For 2 marks, we will discuss this. Let's move forward. In each issue, we should identify, put a heading of the issue, discuss a relevant standard relating to that issue, and then discuss what could be chance of misstatement. To help cash flow in year of expansion, the company raised finance by issuing debentures which are potentially convertible into equity on maturity in 2025. So company have issued a debenture, convertible debenture company have issued. So put the heading what debenture. And debenture is what financial instruments. Relating to financial instruments, we are having 3 accounting standards. One is IAS 32 relating to classification of financial instruments. IFRS 9 due to measurement and recognition. And we are having one more accounting standard, IFRS 7, relating to disclosure of financial statements, financial instruments. Debenture is what? Financial instrument. So we'll discuss per IFRS 9. In case of debenture, the debt component and equity component should be separately classified because this is convertible. I mean, there is option of converting into equity as well. So per IFRS 9, debt component and equity component should be separately classified. And debt component should be recorded or should be calculated based on discounted at maturity method. So debt component should be accounted for based on discounted at maturity method. The balancing figure should be recorded as equity. In case of debenture, debt and equity component should be classified separately per IFRS now. Debt component should be accounted for using discounted at maturity method, and the balancing figure should be recorded as equity if company is not recording as per above criteria. If company is not accounting as per above criteria, chances that financial statement could be manipulated. If you are not aware about what could be under, over, or there are so many under, over, so we'll use the word manipulation. If company is not accounting as per the above criteria, chances that financial statement could be manipulated. And per IFRS 7, detailed disclosure of debenture must be provided in the financial statements. If there is no detailed disclosure, financial statement could be misstated. Whenever we will be having an issue relating to debenture, we will always discuss these lines. Mean we are cramming as well. Mean what things we need to discuss for a particular account balance in audit risk question. In case of debenture, we will always discuss this for IFRS 9 and for IFRS 7. Are you with me? So how many issues we have discussed? 1, 2, 3, 4. Four more we need to discuss. Let's see. To manage the risk associated with overseas expansion, in October 2009, the company entered for the first time into several forward exchange contracts, which end in February 2010. Hedging. The contract were acquired at no cost to Papaya company and are designated as a hedging instrument. We'll put the heading hedging. Again, on hedging, these three standards will apply. The hedge are of two types: fair value hedge and cash flow hedge. In case of fair value hedge, change, or we can say gain or loss relating to change in fair value. Due to change in fair value, any gain or loss relating to fair value hedge should be charged to profit and loss account. While in case of cash flow hedge, any change in fair value gain loss should be charged to other comprehensive income. IFRS 9. change in fair value gain loss relating to fair value hedge should be charged to profit and loss account, while change in fair value gain loss relating to cash flow hedge should be charged to OCI. And if company is not accounting as per this criteria, financial statement could be manipulated. So we'll discuss here under the hedge heading hedge per IFRS 9. Change in fair value gain loss relating to fair value hedge should be charged to P&L, while change in fair value gain loss relating to cash flow hedge should be charged to OCI. If company is not accounting as per above criteria, financial statement could be manipulated. Can we discuss this? Now I'm going to discuss this a little bit in different way, more technical. So we'll say per IFRS 9, change in fair value gain loss relating to fair value hedge should be charged to P&L, and change in fair value gain loss relating to cash flow hedge should be charged to OCI. There could be chances of misclassification. There could be chances of misclassification of cash flow hedge to fair value hedge. Of cash flow hedge to fair value hedge in case of gain. Because if company will misclassify to fair value hedge, ultimately they will be able to highlight the profit, because now gain will be recorded in P&L instead of OCI. So there are chances of misclassification of cash flow hedge to fair value hedge in case of gain, or misclassification of a fair value hedge to cash flow hedge, especially in case of loss. In there is fair value hedge and there is a loss. So instead of recording loss to P&L, they will misclassify to cash flow hedge so that they can report loss where OCI rather than the profit to highlight the profit. So paragraph 9, change in fair value gain loss relating to fair value hedge should be charged to P&L, and change in fair value gain loss relating to cash flow hedge should be charged to OCI. So there are chances company may misclassify cash flow hedge to fair value hedge in case of gain, or fair value hedge to cash flow hedge in case of loss. The word misclassification is explaining what misstatement. And then we will discuss per IFRS 7, detailed disclosure about hedge must be provided in the financial statement. In case of no disclosure, financial statement could be misstated. Are you with me? So we have discussed about brands, we have discussed about segments, we have discussed about penalty, we have discussed about debenture, and we have discussed about hedge. Let's move forward. The property market has slumped this year. There is a slump in property market. And significant losses were made on the sale of some plot of land which were originally acquired for development potential. And companies are facing losses on some of the sale of land that they bought. The decision to sell the land was made as it is becoming increasingly difficult for the company to receive planning permission to build supermarkets on the land. And the land is recognized at cost in statement of financial position. And they have decided to sell the land because that land was bought for building a supermarket on the land, but they failed to receive the permission. This means if the land value is lesser in the market while selling and they have recorded on cost, so chances that land is not impaired. If there is no impairment, asset profit could be overstated expenses, understated, so we'll put the heading what land. And we'll discuss per IAS 36. If asset carrying value is higher than recoverable amount, there must be impairment of asset, and company land market value is lesser than the cost, So if land is not impaired, chances that asset profit could be overstated and expenses understated. We can discuss this. Let's move forward. Papaya company has 35 warehouses which store non-perishable item of inventory. The company is having some warehouses where they store non-perishable inventory. Due to new regulations, each warehouse is required to undergo a major health and safety inspection every 3 years. In every warehouse, legally required some inspection. All warehouses were inspected in January 20X9 at a cost of 25,000 for each inspection. Every 3-year inspection is required. These compulsory legal costs relating to the asset. This is what legally required. Every 3 years, you need to incur this cost for inspection. These compulsory legal costs relating to the asset should be capitalized per IA 16 and depreciated over the period. Mean this 25,000 must be capitalized and must be depreciated over 3 years time period. And if company is not capitalizing, mean recording complete cost as expense, are capitalizing but not depreciating over 3 years time period, so chances of manipulation in the financial statements. So we'll put the heading what? Warehouse. So for IA 16, compulsory legal cost relating to asset must be capitalized and depreciated over period. So this 25,000 must be capitalized in current year and must be depreciated over 3 years time period. If company is not capitalizing, charging complete as expense, are capitalizing but not depreciating over 3 years time period, chances that financial statement could be manipulated. And question is finished. Let's see how many risks we have identified. One relating to warehouse, land, hedge 3, debenture 4, penalty 5, segment 6, and brand name 7. But we need to identify 8. So let's move towards the paragraph that we skipped here. Yeah, this was the paragraph. So company opened a overseas branch. Company have opened overseas branch and they invested a huge amount over there and they spent expenses advertisement as well. So we will put a heading overseas branch. Overseas branch. So we'll say the investment for overseas branch should be capitalized, but not the advertising expenditure. If company have capitalized advertisement expenditure, chances that asset profit could be overstated and expenses understated. Company has invested a huge amount in overseas branch, and if that branch is not operating successfully, it could create cash flow issue for the company. So there are chances of misstatement if cash flow issue is not disclosed properly in the financial statements per IAS 1. Even we can discuss about foreign exchange as well, but that we will discuss later on in any other question, because here foreign exchange we are unable to apply complete. I mean foreign exchange gain losses on currency translation should be charged to P&L. If company is not charging to P&L, financial statements could be manipulated. We can discuss that as well. So this is a good question for practice. In this question, we have learned how to explain, assess risk of material misstatement, mean whatever the issue we are identifying, put a heading of the issue, discuss relevant standard, not the complete standard. Relevant point of the standard. IAS 38 also discuss about research and development cost as well. IAS 38 also discuss about goodwill, but we haven't discussed those things. We have discussed only relating to brand. And then what could be the chance of misstatement that we need to discuss. Per segment, we have discussed the standard. What could be the chance of misstatement? Penalty, obviously IAS 37 is involved. We need to discuss the chance of misstatement. Debentures, standard chance of misstatement. Hedging, standard chance of misstatement. Land, IAS 36, impairment, chance of misstatement, and then warehouse. So what you need to do, read the answer of this question carefully and then try to attempt this question. If possible today or maximum till tomorrow. The more gap between our class and your attempt, mean practice, you'll be skipping some points. You will not be prepared properly. So please now onward, try to attempt the question along with the classes immediately after the class on that similar day or at least the very next day. So in next class, we will see some more questions relating to risk of DM statement mean audit risk. In this risk area, we will also discuss about group audit risk as well. And after completing this risk area, we'll move towards non-audit engagement. That will be last area of our syllabus. So see you in next class.
Sir, when is our next class?